You know, it's not every day you see a market on the verge of, well, tanking, and then suddenly it's like everyone's throwing money at it.
Yeah, the Chinese market's been a bit of a head scratcher, to say the least.
It's a real roller coaster, and you guys know we love to unpack those, especially when you ask for a deep dive. So Chinese stocks, huh? What's the deal with this sudden surge? Is this for real, or are we headed for another one of those boom-bust cycles that make you want to bury your savings in the backyard?
Yeah, a lot of investors are wondering the same thing, especially with how volatile things have been over there lately.
I mean, we're looking at articles from Bloomberg, the Wall Street Journal, even The Economist, and everyone seems to agree something big is happening, but no one's quite sure what it all means.
And to really wrap your head around it, you got to look back a bit, you know? Before this whole surge thing, sentiment on China was, well, pretty gloomy. The Economist even had this anecdote, right, about a hedge fund manager who was this close to going all in on Chinese stocks, hesitated, and completely missed out on a massive opportunity. Can you imagine the regret?
Oof, talk about a tough break. But it just goes to show how quickly the tables can turn, right? Like just a few weeks ago, everyone thought the Chinese stock market was dead in the water, and now, boom, it's like someone hit the turbo button.
Right. The CSI 300, that's the one tracking those 300 big companies in Shanghai and Shenzhen, it's up over 20%. And the Hang Seng in Hong Kong, forget about it, up by a whopping 30%. Crazy.
8%, that's nuts. I mean, even the S&P 500, which everyone always uses as the measuring stick, isn't even close to those kinds of numbers.
Not even in the same ballpark.
So what happened? Did the Chinese government just decide to, like, step in and play market maker?
Basically, yeah. Beijing's gone all in on stimulus, trying everything to get things moving again. They slashed interest rates, which is a big deal, like a whole quarter-point cut to get people borrowing and spending. Plus, they eased up on those bank reserve requirements, so banks have more cash to throw around.
And I'm guessing they didn't stop there, did they?
Nope. They've been pumping money directly into the stock market, too. And here's the kicker. They're being super loud about it, you know, like, hey, everyone, look at us, we're fixing this. They're practically promising that if things start to wobble, even a little, they'll jump back in with more support.
It's like they're sending a message. Don't even think about shorting us. But, and maybe I'm just a little skeptical here, haven't we seen this movie before?
You're not wrong to think that. Remember 2014, 2015? China tried this whole stimulus thing before. It was a wild ride, up like a rocket. Then, yeah.
The Bloomberg article actually has this chart comparing the two periods, and let me tell you, it makes you wonder if we're about to see history repeat itself.
That chart from Bloomberg, yeah, that's kind of hard to ignore. So is this a replay of 2015 waiting to happen? Or, are things different this time around?
Well, that's the million-dollar question, isn't it? It's like trying to predict the weather 6 months out. But that Bloomberg article did a good job, I thought, of breaking down the possible scenarios. They laid out 3 paths the Chinese market could take, and each one has some pretty different implications for investors.
Okay, so let's walk through those paths. Hit us with scenario number 1. What's the best case scenario here? All right, so picture this. The Goldilocks scenario. Everything goes just right. The stimulus works like a charm. Businesses are investing. Consumers are spending. But we're not seeing runaway inflation. And that struggling property market, yeah, it stabilizes. China enters this period of, like, nice, steady, healthy growth.
So in this scenario, this whole surge isn't just a blip, it's like the start of something much bigger.
Exactly. And if you were smart enough to get in early, well, let's just say your portfolio's looking pretty good.
Sounds like everyone wins. Okay, so that's the dream. But what about scenario number 2? What happens if things go, not so smoothly?
Yeah, scenario number 2 is the one that keeps people up at night, right? The hard landing scenario. The one that brings back those memories of 2015. This is where the stimulus, it gives the market a little jolt, but it doesn't actually fix the underlying problems. It's like putting a Band-Aid on a broken bone,
Okay, so what are those underlying problems? Remind us.
Well, the big one, the elephant in the room, is debt. China's got a lot of it, especially in their property market. And we've talked about how shaky that market is, right? That's a major red flag for a lot of people who study this stuff. Plus, you've got this whole thing with youth unemployment, which, long term, that can really hurt consumer spending and economic growth.
So, not good. So this scenario basically ends with a repeat of 2015, boom, then bust.
Potentially even worse, honestly. The market could swing back down hard, and anyone who bought in at the peak, well, they'd be left holding the bag.
Okay, starting to get some serious 2008 vibes here. But There's got to be some middle ground, right, between a fairy tale ending and a total meltdown.
There is. There is. Path 3. We could call it the bumpy road scenario. It's not a crash, but it's not smooth sailing either. Think of it as a series of mini booms and mini busts, you know? The market still generally goes up over time, but it's going to be a wild ride getting there.
So less like one giant roller coaster, more like a roller coaster with a bunch of little hills and drops along the way.
That's a great way to put it, yeah. And honestly, given everything going on in China right now, all the different factors, it's probably the most likely outcome.
Which makes things tricky for the average investor, right? Trying to time those ups and downs, knowing when to buy and when to sell, it's like a guessing game, but with your life savings.
It can feel like that, yeah. It's why, and I know we talk about this a lot, but it's why having a solid long-term strategy, really understanding what makes the Chinese economy tick, is so important. Don't just chase the hype, you know?
Yeah.
Do your homework.
Okay, so we've got our Goldilocks, our hard landing, and our bumpy road scenarios. But I think the question on everyone's mind is, like, okay, so what do I do? Should I buy Chinese stocks right now or what?
It's the million-dollar question, right? And like anything in investing, there's no easy answer. But if you want my honest take, we need to look at both sides of the coin here, the bull case and the bear case.
All right, so let's start with the optimists. Why are some people so bullish on Chinese stocks right now?
Well, one of the biggest arguments you hear is that even after this crazy run-up we've seen, Chinese stocks are still, relatively speaking, pretty cheap. The Wall Street Journal was banging that drum pretty hard, actually. They basically said it's a buy, buy, buy moment.
Really? What makes them so sure?
Well, a lot of it comes down to those classic valuation metrics, right? Things like the price to earnings ratio, you know, how much you're paying for every dollar of profit a company makes. And even after this recent surge, Chinese companies are still trading at a discount compared to, well, pretty much everyone else.
So the thinking is there's still room for them to grow, to catch up to the rest of the world.
Exactly. Plus, you've got the Chinese government going all in on stimulus. The bulls will tell you that Beijing has all the tools they need and the will to keep this thing from falling apart.
Okay, so we've got potentially undervalued assets, plus a government that seems determined to, like, prop things up. Starting to sound pretty good. But I know there's another side to this. What are the bears saying? What's making them nervous?
Well, the bears, they're focused on the risks, right? And the big one for them is that this whole rally isn't really based on solid ground. They're worried that the Chinese economy still has some serious structural problems, things that haven't been fixed.
You're talking about that debt bubble we discussed, right? Especially in the property market.
That's a big one, yeah. It's kind of ironic when you think about it, right? The stock market's off to the races, but the real estate market is, well, still a mess. And that disconnect, it's making a lot of people nervous. The Economist had a whole section on this, actually, how the property market is this ticking time bomb.
So the bears are saying, don't get fooled with the hype. This could all fall apart pretty quickly.
Pretty much. They're worried that this whole thing is driven by, like, short-term thinking, you know, government intervention, people not wanting to miss out on the next big thing, rather than any real improvement in the economy.
Okay, so we've got two very different perspectives here. It's easy to get caught up in all the excitement, but as we've been talking about, things could go south pretty quickly. So for the average investor, like, where do you even start?
Well, one approach is to maybe, instead of trying to time the entire market, which is always tricky, you look for more targeted opportunities, right? Specific sectors or companies that might actually benefit from all this, even if things get bumpy.
So instead of betting on the whole horse race, you're picking a horse.
Yeah, something like that. And the Wall Street Journal actually had a really interesting suggestion. They were talking about, get this, Macau casinos. Their logic is that these heavily regulated industries, because they're so controlled by the government, they're probably going to benefit the most from any stimulus or support.
It's like betting on the government's willingness to bail them out.
Kind of, yeah. Plus, those industries tend to have less competition, so they can often maintain their profits, even if the economy slows down.
Macau casinos, interesting. Anything else?
Another area that some folks are looking at is tech, especially those big Chinese internet giants like Tencent. They're already the big dogs, right? Huge customer base, massive growth potential.
Less competition, more potential for profit. I get it. But isn't this all just like chasing the latest trend? What happens if the whole market takes a dive? Those companies are going down with it, right?
That's the risk, right? And it's a risk you always have to balance against the potential reward. There are no guarantees, especially when you're talking about a market as, well, unpredictable as China's.
Which brings us back to, I think, the biggest takeaway from all of this. Don't get caught up in the hype. Think for yourself.
Couldn't have said it better myself. It's easy to get swept up in the excitement, right? But you gotta approach any investment with a clear head. Do your research, understand the risks, don't just blindly follow the crowd.
Because what goes up can definitely come down. Well, that's about it for our deep dive into the wild world of the Chinese stock market. Hopefully you've learned a thing or two and maybe even come up with some of your own questions along the way. The big takeaway here, though, is this. Don't just take our word for it, or anyone else's for that matter.
Exactly. We've given you some things to think about, some different perspectives on this whole thing, but at the end of the day, it's your money, your investments, your future.
So do your homework, stay informed, and as always, thanks for joining us for the deep dive.